Hey there, I'm Jiun. I'm a researcher over at The Expert. Let's talk about a catch in the recent US job report. Today, we are going to break down the latest non-farm payroll, NFP. The unexpectedly strong job addition of 216,000 in the US last month surpasses both forecasts and the previous month's total of 173,000 has influenced investor sentiment. The robust economic data throughout the week led investors to revise their expectations on interest rate cuts. However, Skandar Amanaf, the executive director at Employ America, provides a different perspective on the underlying data, suggesting potential hints of weakness despite the headline job creation exceeding expectations. Amanaf concludes that the labor market should not be perceived as overheated, challenging the notion that the Federal Reserve should consider tightening monetary policy. As he wrote in his note, it could be just noise, seasonality issues, etc. But this job report raises downside risk. The Goldman Sachs also noted signs of a cooling labor market, although the level of concern wasn't as pronounced. On a personal note, I agree with them too. Now, why? Goldman Sachs economists have highlighted that recent job growth has been strongest in healthcare and government sectors, an atypical trend during an economic boom. The bank contends that this isn't necessarily a signal of a recession, but is likely influenced by factors such as tight financial conditions, which are starting to ease, and industry-wide underhiring in previous years, particularly in healthcare. The job report also indicates growth in economically sensitive sectors like retail, construction, technology, manufacturing, and financial services. The breakdown of the NFP data is key, and the significant job reduction in the transportation sector is quite telling. A notable decline in transportation jobs could indeed be an early sign of a weakening economy, as it suggests that there might be a decrease in demand for goods to be transported, pointing to a potential shift or challenges in various sectors. As highlighted in another Bureau of Labor Statistics report, it seems like full-time employment has taken a noticeable dip, in contrast to a modest rise in part-time jobs. Is it possible that this aligns with the non-farm payroll data showing a surge in leisure and retail trade jobs, especially with a substantial increase last month, likely influenced by the Christmas and holiday season? This assessment aligns with the consensus that the job market isn't as robust enough for the Federal Reserve to maintain tight monetary conditions. However, there's an ongoing debate about what precisely constitutes to tight policy, given the gap between Goldman Sachs' expected cuts for the next year of 75 basis points and what is currently priced into the bond market of 126 basis points. This evolving situation will likely continue to fuel debates and analysis in the coming months. The recently released Federal Reserve minutes suggest that the era of rate hikes may be over, but there's no clear timetable on potential cuts. According to FOMC minutes, some participants noted that the healing in supply chains and labor supply was largely completed. Consequently, further progress in reducing inflation might need to come from the softening in products and labor demand, with restrictive monetary policy continuing to play a central role. Thomas Barkin, the president of the Richmond Fed, mentioned that jobs data suggested that the labor market was normalizing nicely following a series of rate increases by the central bank. Market expectations of rate cuts as early as March by the Federal Reserve and the ECB have influenced the late-year rally in stocks and bonds in 2023. However, investors have adjusted their rate forecasts since trading resumed in January 2024, particularly after the Fed minutes revealed that most officials favored keeping borrowing costs high for some time. The Fed officials expect to make 3 quarter points cuts over the year, hinting that rates might need to stay on hold throughout the first quarter. The recent job reports solidifies the Fed's view that March might be too soon for cuts, aligning with their plan of 3 cuts this year rather than the market's forecast of 6 to 7. The evolving dynamics in monetary policy and economic indicators continue to shape the market's expectations and reactions. Looking at what the money markets is pricing in now, it seems like the first cut is likely to be in May rather than in March. Moving over to the Eurozone, Daniel Morris, the chief market strategist at BNP Paribas Asset Management, suggests that the ECB is likely to take the initiative in cutting interest rates, potentially in March or in April. Due to the relative weakness of the Eurozone economy compared to that of the US, he notes that while US growth remains strong, the Federal Reserve can afford to wait for clearer signs of a slowdown before considering rate cuts. Highlighting similarities in inflation rates between the Eurozone and the US, he points out indications of a recession in the Eurozone, particularly in Germany, during the fourth quarter of 2023. Given Germany's significant euro economic influence in the Eurozone, this recessionary signal could have a broader implications for the entire region. Bloomberg's OIS model indicates that money markets are fully pricing in a 25 basis point rate cut by the ECB in April, with a probability of about 50% for rates being reduced as early as March. Similarly, a 25 basis point rate cut in the US is priced for May, with a notable likelihood of a cut in March. Shifting our focus from the US and the EU, it appears there's a likelihood of the UK initiating rate reductions around June. On the other side, there's the chance that the Bank of Japan, BOJ, might put an end to their negative rate policy by September 2024. However, these probabilities are subject to change as more data prints are being released. Back to the US, it is indeed a relief that the Republican and Democratic leaders have reached a $1.66 trillion agreement on the US federal spending for 2024, moving Congress closer to avoiding a potential costly government shutdown just before the budget deadline. The agreement is achieved less than 2 weeks before the deadline, which is a crucial step moving forward. In a letter to Republican colleagues, there's mention of Republicans securing concessions, including a $10 billion in cuts to the Internal Revenue Services and a clawback of $6.1 billion in unused COVID-19 pandemic relief funds. While it's positive that they avoided another government shutdown, the key question remains: how will they be funded? The funding and budget discussions have significant implications, and the topic of quantitative tightening and reverse repo are becoming increasingly relevant. The fact that the Federal Reserve members have brought up these subjects, as revealed in the meeting minutes released last week, underscores their significance in the current economic landscape. So, there's a significant shift happening, hinting a possible change in how the Fed is handling things. So, keep an eye out for our next episode, where we will dig deeper into what the Fed could be up to in the near future. Thanks for joining me today. Everything I've shared are information that I've picked up and learned, sprinkled with a bit of my own takes on things. When it comes to trading or investing, do your own due diligence and be mindful of the risk. If you find this video helpful for your research, don't forget to share it with your friends as well. They might find it useful too. Quickly access to all of our channels by scanning the QR code. Take care, and I'll see you in the next episode.